This is our important day.
Why?
What? We have the meeting with the auditor.
Oh, I'm so nervous.
Me also. I hope we excel with the meeting. Let's go.
We have 15 minutes before the RRB auditors walk through the door. Awni, the regional report just hit my desk with 50 millions in profit. We can keep those offshores and untaxed, right? Please tell me we can.
Breathe, Dina. The answer is no. Under Section 60C, we are a resident bank. That status comes with a world income price tag. Everything, even the Jakarta profit, is taxed right here in Malaysia. To begin this technical overview, it is necessary to address the jurisdictional scope of banking taxation under Section 60C of the Income Tax Act 1967. While the general Malaysian tax system is territorial, resident banks are subject to a world income basis. This means that any profit generated by overseas branches such as operation in London or Jakarta is legally deemed to be derived from Malaysia the moment it is earned. This specialized scope ensures that the entire global footprint of a resident financial institution is captured within the domestic tax net, unlike non-resident banks which are only taxed on income derived directly from Malaysia.
It's the price of residency. If we were a non-resident bank, we only be taxed on income derived from Malaysia. But we aren't. We're in the net.
Not all of us. What about the Labuan branch? I've got the investment committee asking why we're even bothering with the Labuan if Awni is just going to exile under Section 60C anyway.
Tell the committee to relax, Christina. Since 2003, income for Labuan business activity is specifically excluded from the income tax. They follow LBTA 1990 in different government ID.
Good, because I'm explaining a 24% tax hit to the Labuan directors.
Nurin, when you are on the Syariah 5, did you verify the Islamic rings lesson?
Of course, under the Islamic Financial Service Act 2013, we have 10-year exemption for international currency business. It was extended to 2020. I have been confirmed our lesson is current. That massive tax sheet was sitting on.
It is important to highlight the principle of tax neutrality. Under Section 2, Subsection 7 of the Act, Malaysia ensures that Islamic banking profits are accorded the same tax treatment as conventional interest, so that Sharia-compliant models are not at a fiscal disadvantage. Furthermore, banks benefit from the single-tier dividend system. Since the companies in which a bank invests have already paid their corporate tax, the dividends received are classified as exempt income. This system effectively prevents the double taxation of profits, ensuring greater efficiency for the financial institution and its shareholders.
Let's talk about my bond portfolio. We have moved heavily into 0-coupon bonds. We bought them at a deep discount. In other industry, I wouldn't have to worry about the tax until the bond matures and we get the cash.
But we aren't any other industry, are we?
Partly, Budget 2006 slammed that door shut for banks. We operate on a pool basis.
Exactly. Even if I haven't seen a single cent of profit yet, but we have to tax the discount income annually. On the flip side, we get to deduct the premium expenses annually too. It's a bookkeeping nightmare, but it's the law.
Wait, I see a 2 million into this payment to UK investor. We didn't withhold the 50% tax. Are we in trouble? Relax now. Paragraph 33, Schedule 6. Interest paid by lesson to non-resident is usually exempt.
Usually, it's a dangerous word, Maureen. Christina, where did the UK money go? If you use those funds to maintain the networking funds prescribed by Bank Negara, that exemption is there.
Instead in the investment pool,
33A and 33B. As of year 2017, if we pay interest to the company in our own group, even SPV, the exemption is gone. The IRB is looking for circular money.
This is what scares me, non-performing loans. The customers aren't paying, but why are we paying tax on interest and suspense? It's money we don't have.
It is the oldest fight in Malaysian banking tax.
Look at the stars on this legislation. In 1999, the government made 15% of the suspend account taxable. Regardless whether we collected it or not.
Oh, I remember the average talking about that. It nearly broke the smaller banks.
Thankfully, by 2001, it became deductible under Section 34 Subsection 2. We only pay when we realize the income.
But what about year 2020? The world stopped when MPS went through the roof during the lockdowns.
Guys, look at this. Prihatin moratorium. From April to September 2020, the interest was not treated as income for us. It was a lifeline from the ministry.
A significant area of compliance in the banking sector involves the management of non-performing loans or NPLs. Under Section 34 Subsection 2, the law provides a relief mechanism known as interest in suspense. Normally, tax is paid on interest as it accrues. However, if a loan remains unpaid for at least 3 months, banks are permitted to suspend that interest for tax purposes until it is actually collected in cash. This was particularly important during the 2020 Prihatin moratorium, where the government ensured that interest deferred during the pandemic lockdowns was not treated as taxable income, thereby protecting the industry's liquidity.
Okay, so the loans are handled. What about the shares that Justina sold last month? That's capital gains, right? No tax?
Dina, you're adorable. For a bank, money is our trading stock. Shares are just inventory.
She's right. We cannot claim capital gains. If I sell a security to get a sudden rush of the withdrawals, that's business income.
Settle it with the case law. Siti,
Puncak Cooperative Bank versus CIR. The court ruled that if a bank realizes securities to meet the depositor's need, it's taxable, and supported further by UN Finance Berhad versus DGIR. It settled law.
Regarding investment portfolios, the law specifies that for a bank, money and securities are not long-term capital asset. They are classified as stock in trade or inventory. Following the landmark case of Punjab Cooperative Bank versus CIR, the courts established that selling securities to meet depositor withdrawals is a fundamental part of banking business. Consequently, any gains from these sales are taxed as ordinary business profit rather than capital gains. Furthermore, under rules established in Budget 2006, financial institutions must account for these investments on an accrual basis, recognizing discount income and premium expenses annually throughout the life of the bond.
We're still 1 million over the projected tax provision. We need a deduction. Anything. Wait, the info holding project, the one that was abandoned for 5 years, the one we find at the rescue contract for, I remember that. The risk was huge.
Don't worry, Christina. That risk is off now. Under the 2013 exemption order, if the Minister of Housing certifies it as an abandoned project, the income from that year is exempt for 3 assessment years.
The Malaysian government utilized specific tax incentive to drive socio-economic goals. For example, under the 2013 Exemption Order, if a financial institution provides financing to a risking contractor for a certified bonded housing project, the income from that labuan is tax exempt for 3 consecutive assessment years. Additionally, specialized operations in labuan are governed by the Labuan Business Activity Tax Act 1990, which offer a fiscal framework separate from the Standard Income Tax Act. Islamic Bank also enjoy targeted support, such as the 10-year exemption for international currency business, which was extended through year 2020.
Nurin, find the certificate. If we have that, we are under budget. Found it. Stamp and sign. So, we've got word income under section 66. Our water costs are met, our schedule 6 exemption are verified, and we've got Punjab and UN Finance ready for the legal form. And the single retire dividends already executed. It's showtime. Nurin, cut the coffee. Christina, give the timeline on the board. Ensure we are prepared.
Let's give them hell.
Let's go.